Hi there and welcome back. As of yesterday, May 1st, Amazon stock is up 24% year to date. Meanwhile, the overall market is down more than 10%. What you're getting to see in this video was actually a live webinar for our members where we walked them through the process of understanding situation overview, fundamental technical skills to come up with an investment thesis and a price target. And also, if you wait towards the end, we casted a poll where we ask our audience, should they buy or sell the stock? If you're new to finance, this is going to be a great introduction lecture to teach you the process of coming up with your own investment recommendation and price target. So if you like this video, give us a thumbs up, hit the subscribe button, and don't forget to turn on your notifications so that you're the first to know when we upload and post videos like this. So with that being said, let's get to it. All right, folks, and we're live. Welcome to the Amazon stock analysis. In this particular webinar, what we're gonna do is perform situation analysis, a little of technical and fundamental analysis to determine what is perhaps a good price target for Amazon given the current situation that the market is being faced with in light of the coronavirus. So that's what this particular video is going to highlight, and I'm also going to go more in depth into the process. We're going to show the screens where we find the information, and also I'm going to open our spreadsheet and give you more of a methodical approach so that you can apply this analysis yourself at home, whether you're looking at a stock, you have a portfolio, and you just want to understand a little bit more of the valuation process. In our case, we're going to be applying simple PE multiple analysis. So we're going to first go ahead and cover market update, right? Because before you dive into analyzing a stock, you want to take a closer view at the entire market. What has been happening with the overall averages in the sectors? And also look at rotations, capital inflows and outflow in specific indices, and just telling us what information is happening with each sector that the overall economy is exposed to in the form of index funds. In addition to that, we can also look at major press releases that are driving the fundamentals of the sector and also individual companies. So before we dive into the stock analysis, let's go ahead and share our screen when it comes to analyzing the overall sectors of the economy. And here we go. Okay, so what I'm displaying right now on my screen, on the top left-hand side, number one, we have the major averages. This is what I actually look at. This is one of my screens that I use to help me understand what's happening in the market. So we have the major averages. We have the IWM, which is the Russell 2000 small cap. We have the Diamonds, which is an ETF that correlates with the Dow Jones Industrial Average. We have the NASDAQ, the QQQs, and the SPY, which represents the S&P 500. Now, if you take a closer look at the chart, we can see that the SPY has had a significant rally of the lows over the last couple of weeks, 5-6 weeks. It is a pretty strong bounce of the highs, of all-time highs due to the coronavirus, right? You know, once the coronavirus hit and the economy started to shut down or contract because of the federal government announcing learning a state of an emergency, you begin to see that drastic sell-off. But since then, when the number of cases began to reduce, you begin to see that the market basically started finding a footing, and we had a nice bounce on the SPYs. But you can also see the same thing with the NASDAQ, right? Nice uptrend. You can see that uptrend, okay? And you can also see it with the Diamonds, the industrial average. You can see here a nice uptrend, which we actually started to break this nice uptrend yesterday. Yesterday, Friday, we had a couple of major announcements from some of the companies that lead the market, like Amazon is one of the reasons why the market started selling off yesterday, but it's also profit taking on the overall sectors of the economy and just the general market. So that's what you're seeing right here. If we look at the IWM, notice as well that the Russell also rallied from the low. So you do have harmony in all major averages, where the market is essentially buying the bottom and anticipating a better recovery. Obviously, the federal government, with the stimulus package that they passed, is providing additional money in terms of an emergency funds to consumers, people that lost a lot of their jobs. You know, the latest weekly jobless claim numbers came out to be a total of 30 million Americans have lost their jobs over the last 6 weeks because of the coronavirus. So that is a lot of pressure from a discretionary income spending purchasing power in the economy that we're not seeing right now. So that definitely put downward pressure. And also the Federal Reserve maintained their interest rates where they're currently at in their last minute. So interest rates are virtually zero at the Fed level, but they're also supporting the economy by injecting liquidity in the form of buying government bonds, US Treasuries, and also stepping into the credit market and buying higher risk or junk bonds to support the credit markets and make sure that there's enough liquidity out there in the market. So you have the federal government and you have the central bank supporting the overall economy by just injecting liquidity and also stimulus packages. So this is part of the reason why the market has rallied from the lows. Now, another thing to look at is sector rotation. So since the lows, what sectors have performed best? And one of the websites that actually gives me that information that I like to use is Sector Spiders. Let me pull it up right here on my screen. Sector Spiders, you can see the link, sectorspiders.com. You could go to their website and you can find the sector tracker where you can see those performances. So this was over the last 5 days, best and worst performing sectors. But I care more about the last 4 weeks, the last month, or over the last 3 months. So you can see, if we remove the last 3 months, the worst performing sector is energy. But when you zero in a little bit more closely to the last month, what sector led the market higher? Well, energy. Energy was the worst performing sector because of the price war between Saudi Arabia and Russia. They were pumping out a lot of oil to maintain their market share, yet they were also cutting prices at the same time. But in recent weeks, they came to a resolution where they agree to cut production in order to stabilize a decline in prices. And with that fundamental piece of news is something that perhaps may stabilize the market. So investors view that as a positive to the fundamentals of the sector. And this is one of the reasons why energy essentially is one of the best performing sector during the rally that we've been experiencing. The second best performing sector here, consumer discretionary. And then the third best performing sector is materials. So how do you interpret this information? Is by looking at companies within these sectors and seeing, is there any further catalyst? Is the fundamental of that industry strong enough now to support a continuation to the upside in the weeks and months ahead? So that's up to you from an analyst standpoint to uncover the information and come up with your own conclusion. So first, look at the overall general averages like the SPYs, the Qs, and the diamonds. Then look at specific sectors that have rally from the lows in terms of the best performing sector, and then look at individual companies. And then the question becomes, is this sustainable? Is this rally on the energy sector sustainable? And that is obviously open for debate. If you think that the economy will continue to contract, we're going to have a much deeper recession than what other economists and financial analysts are anticipating. Is your job to do your homework, your research, and come up with your own investment thesis. And once you have that investment thesis, then look at individual companies within these sectors and apply the analysis that we're going to apply in the upcoming slides in our presentation on Amazon. All right. So this is just a little bit more in terms of information on sector update, market update to understand what's happening over the last couple of weeks. Now, if we focus on individual stocks that were in the spotlight, if you will, were companies that were reporting earnings. You had companies like Apple reported earnings during the week. You can see here Apple, right? Not again, similar story with the overall market. Nice rally from the lows. They reported earnings during the week, and so far it seems to be hanging on to those gains. Now the question becomes is, would earnings strong enough to support the current price and then see another move to the upside? Some investors are saying no, Apple is due for a pullback and it might come back down probably to the lows because of high numbers of unemployed Americans, up about 30 million. And when all of this is over, some economists are projecting 40 or 50 million. I mean, that is a very severe number that will definitely impact earnings potentials on a company like Apple. Okay, another company that reported earnings was Tesla. You can see Tesla, just like the overall market, rallying from the lows, a very strong, very aggressive and dramatic move to the upside after correcting. And then the last 2 days, you had a severe sell-off. One of those sell-off was after they reported earnings, but also Elon Musk came out and tweeted that Tesla's stock price was too high. Now, not sure what he was thinking about, why he was making those tweets. Maybe it's coming from a little bit or lack of patience and maybe frustration from the government mandate stay-at-home order. I know he was speaking about that, and he's saying, look, I think that's borderline fascism, and it's not a democratic society when you start to see the government have mandates and a forceful order to its citizens to remain indoors. Again, that was part of his perhaps thought process, but you would really want to examine what was his motive, if it was really just out of frustration to say that my stock is valued relatively high. But again, our job as analysts is not only to look at what he's saying, but also look at the fundamentals of Tesla. Look at comparable company analysis. Look at a DCF analysis. Look at the earnings growth. Look at the amount of production that they have. And is there enough demand for their product? Is there enough demand in the current economy to buy their autonomous electric vehicles? That's really what you need to pay attention to, and not necessarily from what he's saying through a tweet. You need to do your own homework, your own analysis in order to see where the stock should be trading at. But also, I may add that traditional fundamental analysis may not apply to Tesla. This is viewed more as a trading vehicle by a lot of investors now, because it's just defies a lot of the logics and fundamental analysis that we apply as analysts. But then you might need to understand technical analysis and put more of your trading hat and view this stock as a trading vehicle. That's just another perspective on how to look at Tesla stock, because it is very, very volatile. I mean, look at this from February, a high of around, let's see here, we really pay close attention to the high here, this high point, $966. And in a matter of weeks, comes down to 380 or as low as 362. That's down over 50%. I mean, imagine the people that bought up here and are now underwater. At this point, they were down underwater by 50%. And then from this low point, the stock more than doubles in a very short period of time. So it just defies any type of traditional fundamental type of analysis. So if you are a trader, if you're someone that understands technical analysis, you could really capitalize on these violent moves to the upside and downside. So this is one of the stocks that reported earnings during the week that actually influenced the market move. And then, of course, the heavyweight, which we're going to be covering today, is Amazon. Amazon reported earnings as well on Thursday, and earnings were not what investors were anticipating. But I'm going to get a little bit into that in the upcoming slides once I change screens. I don't want to give it all away right now. Another one was Netflix, was another stock that also reported earnings. Netflix seems to be holding strong up here. If we zoom out, you can see a little bit this nice move to the upside. It corrected because of the coronavirus, but it found its footing and then rallied higher because of the stay-at-home economy that is picking up steam, really. So companies like Netflix, companies like Zoom, where people are starting to use their product more, you're seeing an increase in the number of users, in the number of their subscription service revenue. So at the top line, that number, the revenue is actually increasing because more people are starting to adapt and utilize their products. So that's just a little bit of the things that I wanted to cover from a general market perspective, where we've been, where we're at right now, and what would be the next move. And lastly, before I dive into that, here is again the S&P 500. So what you need to ask yourself is, where are we heading next? And you have to always anticipate these moves. We already know that we've come up from the lows. This is a very sharp, violent move to the upside. So we're right here. Are we going to consolidate up here for some time and then break higher? This would be scenario number one, because the economy is going to open up again. Business activity will resume. It might be a little bit slower, but a year from now, we would have put this whole phase or period in the rearview mirror, and earnings will continue to pick up. The unemployment numbers will contract, and things will start to normalize and improve. If that's the scenario that you believe, then that's probably scenario number one, and then you can buy and continue experiencing further upside. If you're on the other side of the equation here, where you're saying, no, we're actually going to come back down, we're going to get worse economic numbers, the economy is not going to open up the way that economists or other analysts are anticipating, and things are going to be worse than expected, and next year's earnings are not going to be what analysts are anticipating, because this will probably have a lasting, prolonged period. This is going to be a deeper recession than what most experts are expecting. Then if you're in that camp, then you're probably saying that we're going to keep growing, moving lower and revisiting this lows. This would be scenario number two. Now, for each scenario, again, you need to do your own homework. You need to do your analysis. You need to pay attention to economic data, and then try to make sense of what's happening and formulate your own opinion and see which direction you think the markets or the economy is going to go. Is it going to be scenario number one, or is it going to be scenario number two? So that's what I wanted to cover on the market from a market update perspective. So now let's dive into Amazon, and hopefully this will give you more of a guideline and process on how to perhaps evaluate and analyze your own company within the sector that you think will benefit, or you think will not benefit and has further moved to the downside, and you might be looking to short. So you could also be a contrarian in this market in certain sectors. Okay, so let's go ahead and continue here. So in terms of the process of analyzing a stock, we've discussed this in previous lecture. The first thing you want to do is apply your situation overview. Where has the stock been? How is it doing year to date? Okay, try to understand major press releases that is giving us an indication of how the company is performing currently and in the previous quarter. So we're going to do that because Amazon actually reported earnings, and we're going to briefly look at those earnings to get better information to assess their situation and how they're handling the coronavirus. The second thing you want to do then is apply a sense of technical skills. You could apply technical analysis by looking at the charts, and you can apply fundamental analysis by looking at top-line revenue growth, looking at the margins, looking at earnings per share. Where will earnings be a year or 2 years from now? What is the growth on that earnings? And what is a multiple that the market is paying for Amazon? But more importantly, what are you willing to pay for those earnings? Are you willing to pay a premium higher than what the industry average is? Are you willing to pay a lower premium for whatever reasons you might come up, because you might think Amazon is too expensive at this point, and you might have additional information that the general public doesn't have. So other investors might have blind spots in their investment thesis that you might probably, through your own creative idea process, can identify and maybe come up with a worst case scenario approach for Amazon, and then you might want to short the stock. So this is part of that process. So you can apply DCF. You can apply comparable company analysis. You can apply PEG ratio analysis. Some of the parts, if you even think it's applicable to a company like Amazon, which I don't think it's applicable, but that's how you can apply your fundamental skills in order to come up with a price target on the stock. And then lastly, your investment thesis. What are the reasons why you are buying the stock or selling the stock? So this is more of our process that we're going to apply to Amazon. So in the next slide, of course, is how has the stock performed year to date? And when you look at the stock performance, it releases information even in this current market environment. So obviously we can see that Amazon stock, it's up year to date approximately 24%. Meanwhile, the general averages, the NASDAQ, basically flat. The S&P 500 is down 12%. The Dow Jones Industrial Average down 16%. So why is Amazon outperforming the general market and also performing better than other sectors like airlines, industrials, restaurant, hotels, casino, more of the sectors that are exposed, that have a higher exposure to consumer discretionary, right? So Amazon is really showing that they are navigating this period, this challenging period very well, better than other industries. So if they're outperforming everyone else, so there's something to it. This is probably a stock that you may want to look at because it might have continued momentum towards the upside. It just shows the level of resiliency that their business model has, that that allows them to adapt and still perform in a very challenging period. Now look at what happened during the coronavirus case, right? When the press releases hits and then things got worse, the economy began to shut down, businesses started to close their doors and mandating their employees to work from home. Amazon stock declined 20%. But after, and this is important, this period right here, this is where you got the stimulus package passed by Congress, and also the Federal Reserve came out and said, look, we're going to inject as much liquidity as we have to support the economy. So they basically put a floor in the market. And look at the strong rally since that point on Amazon, right? That's actually, this is a monster move. But when you look at year to date, when they first started up around here, I believe it's in the 1850 price level, and now they're at around 2287 price. It just shows the resiliency and the amount of support that the general investor community is putting behind Amazon, because they think Amazon actually is going to come out ahead when this is all over. They're going to increase their market share because of other businesses, maybe smaller competing businesses are just going to go out of business because they don't have access to capital markets. They don't have access to raising equity or debt the way that Amazon does. So you have to be able to understand the motives and the reasons behind Amazon being up 24% year to date in a situation where we are faced really with a recession in this pretty challenging period. So that's the first thing, right? Looking at the stock performance and where they're at year to date. In addition to that, Amazon reported first quarter earnings. So now we're diving into the fundamentals. How has their business been performing? And what I'm illustrating in my screen is a screenshot from one of the databases that I actually use to get some of the financial information, which is known as Thomson One, provided by Thomson Reuters. And what you can see here is what the street was expecting on the mean column in terms of earnings for Q1, their first quarter, and what was the actual reported number. So you can see here that they beat on the top line. And again, it shows strong resiliency. And another thing is that Amazon has diversified their business. It's not just an e-commerce platform. They have their AWS, they have their device like Alexa, Fire TV, they have their own movie production and content creation studio. I mean, they have so many things that allows them to still perform and beat at the top line. Okay, but here was the challenging part. At the bottom line, when you see here EPS reported on a GAAP basis, they've missed. The street was anticipating $6.18, and they came in at $5.01. So they miss on the bottom line. Another number, very important, that you might want to pay close attention to is EBIT, operating margin, which is this line right here. Okay, the street was expecting roughly $4 billion. Amazon came in at 3.9, just shy at their EBIT numbers. And why is that? Well, Jeff Bezos actually provided more information and transparency on why they missed on the bottom line and at some of their operating numbers. And a lot of that really has to do, obviously, with the coronavirus, the challenge that they're facing. So let's go ahead and see if we can get a little bit more clarity in this with these numbers and try to really understand what it is that they're saying. So here it is. And I think one of the most important takeaways from the earnings report and the call that Jeff Bezos mentioned is right here in this quote. He says, if you're a share owner in Amazon, you may want to take a seat because we're not thinking small. And by thinking small is all of the processes that they're adding to their business and changing to improve it. That's number one. Secondly is the amount of money that they're going to have to reinvest into the business in order to maintain and operate in a very challenging period where the new course of action might be living in a world where these viruses might be a more of a frequent occurrence basis every flu season. Every year we might be going through this. I mean, just look back. We've gone through I think one was the swine flu. Then you had another one. It's not coming to mind, but I think it was SARS. Then you had E. coli. I mean, these viruses keep coming up more frequent now. So every year we might be experiencing these viruses. So it does require Amazon to invest in their business to protect them from any other further future outbreaks into the future. And you're seeing here in the first quarter reports, they're just saying how much revenue increased. And I mean, this is an impressive number. Increased 26% in the first quarter when compared to the previous year. Operating income, of course, decreased. Their net income obviously decreased because of the amount of money that they're reinvesting. And they even gave us some guidance. I'm not going to go too much into the guidance here. I want to focus more into what they actually said in their business operations, what specific action plans and things that they've executed to help them improve their business in this challenging period. So the next slide gives us that information. So here, this gives a little bit more transparency. One of the important things is that, look, we expect in Q2 to make $4 billion or more in profits. We expect to spend approximately the $4 billion that they might generate in operating income or in operating profits in COVID-related expense. And what does that mean? Well, it means one, they want to keep their employees safe, but more importantly, protective equipment, enhanced cleaning of their facility, less efficient process path that better allow for effective social distancing, higher wages as well, and hundreds of millions to develop their own COVID-19 testing capabilities. So this is what Jeff Bezos meant when he said, we're not thinking small. If you are a shareholder in Amazon, well, take a seat because we are going to be improving our business, the infrastructure, so that if any future outbreaks happen like this, we're not going to get this level of disruption. We are preparing for the reality where we live in a world where we might have more of these freaking viruses. So we have to strengthen the operations of our business. We have to really invest in the infrastructure. And that's what this is referring. So this is interesting. Also, during the quarter, this is impressive. Amazon made over 150 significant process changes in our operations network and Whole Foods market stores to help teams stay healthy and conduct daily audits of measures we've put into place. I mean, when I first read this, from an entrepreneurial standpoint, obviously, building Romero Mentoring, building the platform, creating content, improving our website, improving the messaging, and also improving our lectures and coming up with more programs to help students learn how to develop these skill sets in the form of online training curriculums. It's really amazing and also impressive that Amazon, at the scale that they're in, they can continue to improve 150 change or make 150 changes in their operations to continue to maximize and improve their efficiency. This could be warehousing, this could be their ordering, this could be their advertising, maybe the way products get shipped to one place to another in terms of delivery and logistics. I am blown away to how detailed they are in running their operations. And this really drives at the heart of what Jeff Bezos has done. And it's all in line with the principles of running his business. And one of the core of those principles is innovating, having a passion to continue to improve and innovate, also being obsessed on customer satisfaction. How can we continue to provide value to our customers where they continue to order from us and use our platform and our products and services so that no other company can compete with them? I mean, this is at the level that they're operating, and I am not surprised that they've created the business that they've created when you see them detailing in their quarterly reports the amount of significant changes and processes that they added to their system. This is more from running a business standpoint. Now, from an analyst standpoint, you could read this and say, okay, 150, I understand, that's fine. But when you're an entrepreneur and you have experience in building businesses, you really appreciate that because you know how hard it is to create a business from the ground up when there's not a blueprint for you to follow when you're creating a unique experience and value proposition for a customer. It's impressive. Now look at the third bullet point here. In March and April, Amazon announced plans to and have now hired 175,000 people. Meanwhile, you have other industries laying off and furlough employees, reducing their headcount. Meanwhile, Amazon is expanding. They're hiring more people. And in addition to that, they are spending approximately $700 million by increasing their employees' hourly wages. So you see, they are reinvesting in their business. They're really gearing up for the next phase of economic expansion after we go through this Corona period. And you can see what they're doing right now. You're seeing that they're not contracting. They're not laying off people. No. They're growing. And I can actually show you what they've done over the last 25 years during times of crisis. And during times of crisis, they actually expand their business. They don't contract. And they gain market share. That information. So just bear with me because it is important that I really show you what this means so that you can see that this is not the first time Amazon goes through a crisis. And if we can find it on one of my other screens. Here it is. I think you're going to find this rather interesting. And this is part of the analysis that I do in learning about a business, which is something you can learn yourself and maybe build or copy part of the things that I'm doing so that you can learn how to look at the history of a company and really study them. Here. So this is Amazon's performance from 1994 when they first started, when Jeff Bezos founded Amazon, and then when they did an IPO in 97 to how they performed to 2019. And of course, I haven't updated this column, but now they're in 2020. Look what happened during the dot-com bubble. You see right here, headcount row 16. This is the number of employees. You can see here, they actually contracted a little bit. So they contracted in this period. But then look at the financial crisis, during the financial crisis period. 2008 and 9, right here, this period right here. Look at their number of employees, actually, this right here. So employees in this first period. After the dot-com bubble, we went through a recession period. But then look at the financial crisis, their headcount, number of employees. They kept increasing their headcount. They kept expanding their business. And in 2019, down here, look at the acquisitions that they actually made. Let's see, right here. Okay, we got it back. Look at the acquisition. So they were actually acquiring businesses right in the heart of the financial crisis. And then in 2009, when we experienced the worst and we were perhaps finding a bottom and coming out of that bottom, Amazon was making acquisitions. They were expanding their business. So it's not the first time that they go through this crisis. And then from there, from 2009 to 2019, that last period and decade, look at the number of employees. Look at how fast they grew their headcount. It's significantly. See here, row 16 is how many people they're hiring. It's significantly. So now we can expand this to 2020, right? And we can say that in 2020, they added 175,000 new employees. And then this number obviously will increase. I have to update 2019. But this is what you may have to do when you're doing your due diligence on the company if you really want to understand the story and see how they ramp up and scale their business. And I think this is a really interesting story, how Amazon in the first years, they started basically just selling books through their e-commerce platform. You're seeing it right here. Then in 1998, they're expanding to music and DVDs, and then they added more products the following year, and then they enter other markets. Folks, this is the blueprint of how you build a business with one product, then you introduce additional products to grow the top line, then you hire more people to help you sustain and grow, and then you launch in other markets geographically to become an international global brand. And after 15 years, then you can go ahead and start embarking in M&A activity to continue to grow your business. This is the blueprint right here. This is why they are what they are today. That's it. So I hope you find that rather interesting and valuable. You could do this on your own. I'm not going to share this screen, so please don't ask me to share this. At least I'm showing it so that you can do it on your own, because I spent the time in finding the information on the from the SEC filing, looking at all of their financials on a 10K basis to put this together, so that I can understand a little bit more of Amazon and how they were able to scale. So this is very valuable if in the future you want to be an entrepreneur and you want to start a business. From an analyst standpoint, the information that you're getting here is just to see the amount of growth, headcount, and maybe margin improvement, and how the business have changed from their early days to where they're at today. Okay, so I thought that was rather interesting, and gives you a little bit more understanding of why they're hiring people. So during recessions or challenging economic periods, they're actually expanding, they're not contracting. So this is not their first rodeo. This is not the first time that they've gone through this. So this is interesting, and I see it. And this is why they're also investing more heavily on their operations and increasing their employee wages. So they're probably going to be one of the winners coming out ahead during this period. Now you can see why the stock is up 24% year to date. They're also doing other things by providing support to customers in the community. In terms of business highlights, something more to add is they mention that they're also improving their shopping experience, their entertainment devices, like Amazon Fire Stick, Alexa, Amazon Web Services, and of course they provided more financial guidance, which we saw in the previous slide, but I didn't cover that in greater extent. But this is the respond in the last 3 months, information that you can uncover from just reading their press release on their first quarter earnings response. So if you're looking at a company, number one, look at the stock. Look at year-to-date performance. Number two, look at the most quarterly earnings results and see what type of operational improvements or development management or the CEO and CFO are discussing to expand and grow the business. And also, what is the expected growth for the business when they provide guidance? So those are some of the things that you can pick up from looking at the press releases in their quarterly earnings report. So I hope this gives you, a clear picture of what they're doing, how they're investing in their infrastructure, and how they are adding more headcount so that once this period is over, they can come out ahead bigger, stronger, and they can gain market share. And again, the stock price is really reflecting what they're doing, and the market likes it. They like what they're doing. And look, from my personal opinion, I like what they're doing because this is actually some of the things that I'm doing myself with Romero Mentoring in order to expand, scale, and just provide more quality content and educational training programs to improve this skill set that I'm sharing with you right here. And we go a lot much more in depth in our program. So let's move on to the following slide. In our following slide, we're now showing the expected earnings from revenue, margins on the EBITDA and EBIT side, and also net income and our bottom line earnings per share. So that's what you're seeing here. So something that's very important and noticeable, obviously, is 2020 expectations. The rest of the street, right, the consensus number, a collection of analysts that follow Amazon and then they provide their consensus. This is the aggregate, the average. The street is expecting a 6% contraction on earnings, which is the bottom line. Why am I highlighting earnings? Because as a shareholder, if I own the shares, my claim to the business as an equity holder is their earnings, their net income. How profitable are they? And how much, when you take the net income and divide it by the shares outstanding, you get earnings per share. That's the claim that I have as an individual shareholder, $20.42. Now, the growth matters because it shows how much bigger my earnings are growing, or my piece in the pie is growing. And then what am I willing to pay for this earnings growth? So when you look at 2021, look at the expected earnings growth, 76%. So the street is expecting that Amazon will have a decline period, but next year it's going to rebound and you're going to see 76% earnings growth, and you're looking between $37 on a GAAP basis and $38 on a normalized basis. Now the question becomes, and again, this is open for debate, what are you willing to pay for those earnings, for that growth? Are you willing to pay the industry average? Are you willing to give them a premium? That's up for debate, and only you can answer that based on your risk appetite, based on your investment approach, your philosophy, what you may think about the company, whether you like them or you don't like them. All of that should drive your answer in determining if you should buy the stock or not, and what are you willing to pay from a fundamental standpoint on those earnings. All right. So in our next slide, we can see a little bit more clear the comparables, right? The landscape, the industry that they're in. And we pull up these comps directly from Capital IQ, which is another database that provides us with financial information. And you can see the companies that Capital IQ deems as a direct competitor to Amazon. So that's Google, Facebook, Alibaba, Bookings, eBay. I mean, Chewy.com, this is actually interesting. I did not know about Chewy.com until I pull up these comps. And Chewy.com is essentially the Amazon of pets. That's what Chewy.com is. From a strategic standpoint, if you're looking at this from an investment banking standpoint, I wouldn't be surprised if Amazon in the future acquires Chewy.com to expand into the pet industry. I wouldn't be surprised if they acquire Chewy.com. This is interesting, and I can see a lot of reasons why this would be a good strategic fit for Amazon. So that's more from an investment banking standpoint. And then you could do your mergers and acquisitions model, determine the accretion, dilution, what will be the premium paid on this company. So then you can go a little bit more in depth in the analysis and really perform the type of modeling that an investment banker would put together for this type of transaction or this idea. So you have Wayfair, you have Expedia, Zillow, and Grubhub. These two might be questionable in terms of comps, but I just decided to include it because this is what Capital IQ provided, and I just want to discuss it in here, and then also look at their multiples, their profit margins, and how they compare with the industry and also with Amazon. Now, what's the utility value or the purpose of looking at all of these multiples? Well, it's because when we take the average, the mean and median of the industry, it helps us understand if Amazon numbers are above or below the industry average. And when we compare very specific financial metrics like earnings growth, in this case, Amazon is growing at 75%. The median is 24%. The average is 77%. Now, the average is obviously being skewed by one company here, which is Expedia. You can see here 608%. If you remove Expedia, you'll get more of 24% for everyone else in the industry, give or take. And then, of course, the margins, how profitable is this business or the industry. So you can see most e-commerce digital business have a EBITDA margin of approximately 26 to 28%. But look at Amazon. Amazon is 12.2%. So from an EBITDA standpoint, and EBITDA essentially is an approximation for how much operating cash flow the company generates. In other words, per every dollar of sales that comes in, how much are you keeping in cash flow for that? How much do you get to keep as part of your operating cash flow? That's what it means. So for every dollar, Amazon is keeping approximately 12 cents. Meanwhile, the industry keeps approximately 26 to 28 cents, almost double what Amazon gets to keep. So you begin to think, if Amazon is less profitable than the industry, then why are they trading at a higher multiple? From an EBITDA standpoint and from a PE standpoint. And when you look at their growth, right, they are, well, if you compare the growth to the median, extrapolating this 608, they're growing faster than the industry, so maybe they do deserve a premium because they're gonna grow earnings, and ultimately their margins will pick up economies of scales, and they can improve more efficiencies. Like you saw in the previous quarter, in the previous quarter, they've made 150 significant updates in their process to improve efficiency, which will impact those margins. So if you are an investor and you are anticipating that margins will expand along with their earnings, then maybe Amazon does deserve a premium. But that's up to you. Who knows? Maybe I'm wrong, but that's how I'm interpreting the information. And it's your job, again, as an analyst, to interpret this information in your own way and see what you're willing to pay. Does this make sense? Is it reasonable? Is it logical? And you can come up with your own investment ideas. Now, at first glance, if you're not even looking at Amazon, you could look at other companies in this space and maybe come up with other investment ideas. For example, you could see the best two performing stocks in this index or in this set of comps is Chewy and Wayfair. Okay, but look at their earnings over the last 12 months. So these two companies are actually losing money, especially in a challenging environment. You can see here the earnings growth. One is negative, the other one is higher than the other. And again, obviously the gross profit margin is negative, yet they're up year to date. So maybe Wayfair, they're up 35%. Meanwhile, earnings are expected to decline this year. Then you might have to look at earnings for next year and see if they're profitable. If they're not profitable, then maybe the stock has gotten ahead of itself. Maybe it's a short opportunity. Chewy, okay, you can see the earnings growth. Maybe next year or in the next 2 years, they're gonna be profitable and maybe their margins will be better than the industry average and they're gonna continue to grow because people, they just love their pets. Pets are viewed as part of the family. I mean, look, I have a cat and I love my cat. And we do spend money on our cat. That is like our third member of my family. And I do treat my cat, dearly. So we do spend money in premium products because we want to extend the life of our pets and we treat them again like our family members. So take my example and multiply by millions of Americans that own pets. They're gonna be buying from Chewy.com. So you do potentially see strong fundamentals, the consumer behavior in motivating them to basically buy from Chewy.com. So it has legs. The fundamental story is perhaps strong, and this could be a stock that can continue to outperform the rest of the market over the next 18 months, 24, or maybe in the next 2 or 3 years. But you have to do your analysis. This is how I interpret this information, just by looking at this at the surface level. If we start to write things down in back of the envelope, ideas on how do we justify this. So this is what we can interpret from looking at comps and maybe coming up with new investing ideas. So just looking at comps, it doesn't just tell us the industry averages. It has more utility value to it. There's a lot more meaningful information that we can interpret and come up with ideas to invest. Okay? So I hope this was insightful. Now let's continue to our next slide. So our next slide, now we're diving more into price targets. So what have we covered so far? We looked at how the stock has performed. We looked at their situation. We also interpreted and read their most recent quarterly performance, and we saw what Amazon is doing right now. We also looked at the industry average. We looked at multiples and profitability, and now we're gonna see price targets. What is the market willing to pay for those earnings? And what am I willing also to pay for Amazon earnings? And then what would be a price target that we can come up with? So here, I'm illustrating what some of the major firms out there are saying or what price targets they have. So Credit Suisse, $27.60, $2,760 price target. You have Raymond James, $25.25. You have Guggenheim Securities, $2,700. You have Wells Fargo Securities, $27.50. Right next to this, notice that I have mean and median, my average and my median price target. And this mean and median price target is a collection of 46 analysts on the streets that do cover Amazon, and they've reported their own price target. So this right here is just a collection of the aggregate average of all of those analysts' price target. And you can see that the price target, we can say, if we take just the midpoint of all of this, let's just say 26.70, right, would be the price target if we take the average of these two, okay, give or take. So that's what the street is anticipating for Amazon, which is higher than the current stock price. Now, the table that I created down here is price to earnings valuation multiple. I am simply taking their expected EPS for next year, and I'm applying the industry multiple, I'm applying their current LTM multiple, and then I'm also using PEG ratio to come up with an implied value or an implied PE multiple that the market might be willing to pay for the stock. And that's what we are doing with this table. So let me walk you through this a little bit more. So you see here the current price, $22.86. This is as of Friday, May 1st, okay? Normalized EPS. So this is what the street is expecting EPS to be, as you saw in the estimate slide that we went over. And this is the growth, okay? So 2021, 76%, all right. The industry PE, as you can see right here, the median is 19.5. Where did I get this number? I got it from the comp slide. If I go back, see here, 15.6, 18. If you look at my EBITDA at the orange column, 18 and 15. So I basically said, look, at 19.5. I even gave them a little bit of a premium. I went at the high end of the range, so 19.5. And if you take that 19.5 and multiply by the expected earnings per share, you can see the price target, right? So 2021, 38.16 times the industry PE, $744. The stock would come down by 67%. If you take 2022 EPS estimates and multiply by the industry PE of 19.5, you get $1,000. That's a 54% correction. But of course, the market investors are not paying the industry average. They view Amazon as a premium company. They view Amazon as being very well diversified. And obviously, Jeff Bezos, what he's created, also holds a lot of weight. Very competent and talented management team. And of course, you know, Jeff Bezos, what he's created, and him being the CEO perhaps warrants a premium. So let's look at using Amazon's current PE multiple. If we make the assumption that the market will continue to pay the current PE multiple of Amazon 109 times, if we apply this PE multiple to 2020 earnings, you get 23.74 price target. That's only a 4% upside. If we look at next year's earnings, 38.16, and multiply by their current PE multiple, you get 41.67. That's a 82% increase on the stock price. And the same thing, if you look at 2022, right? As the earnings increase, as the EPS increase, and the multiple stays constant, look, you see here at the price target, it basically increases. But now it's open for debate. Will Amazon maintain their current PE multiple? The answer of that is obviously no. Why? Because earnings increase and decrease. And as earnings increase and decrease, that growth rate deserves a higher or lower multiple. So the market in real time is adjusting. And the share price, the volatility, the multiple expands and contracts depending on the current market environment. So you need to account for that in real time. You need to understand that the growth of earnings impact the multiple. Multiples expands and contract the same way the stock increases and decreases will impact earnings. So you need to anticipate that 6 and 12 months ahead and apply this level of analysis yourself so that you can get familiar with this level of analysis. And again, is this the only way of valuing a stock? Very important. The answer is no. This is a very simplistic approach. There's other ways of valuing Amazon. We could have done a discounted cash flow analysis. We could have done perpetuity method and the terminal EBITDA method. We could have also probably done a leverage buyout just to see if financial sponsor, private equity firm wants to buy Amazon. Obviously, it's not realistic, but just for entertainment and as a, for all funds and purposes, we could have done an LBO model to see what will be the implied valuation if someone acquires this company. Okay, we could have also applied precedent transactions. So there's multiple methodologies in valuing a company that we could have applied. But I'm trying to keep it at a simple level to present to you a clear and easy step-by-step approach of just applying PE multiple ratios so that you can do this at home. This is probably the first way of valuing a stock that you should learn. Then once you understand this, okay, pick up DCF. Then pick up precedent transaction, then pick up sum of the parts, then pick up leverage buyout and merger consequences analysis. That is a gradual process in learning these technical skills to apply valuation to a stock in any company. So let's continue. So then we say, okay, so what about from a PEG ratio standpoint? So if we're paying 1 times for the earnings growth, where am I getting this 1 times earnings payout growth? Look at the previous slide. You see here in my PEG column, I have that number. And the reason why I calculated this number is I want to see what the industry pays for the earnings expectation of the company, the earnings growth. Essentially, the way to simply understand PEG ratio is your growth should equals your multiple. So if your earnings is growing by 10%, your PE multiple, if your PE multiple is 10, then your PEG ratio is 1. 10% growth, PE multiple of 10, the PEG ratio is 1. If your earnings growth is 20% and your PE multiple is 20 times, then you have a PEG of 1. So essentially, that's what the market in this industry is paying when you look at the median, right? And again, with the median, we are extrapolating any outliers, like bookings. I mean, look at bookings, 5.8. This is another perhaps idea that bookings might be expensive. You may probably want to short it. So you see how you can get information from comps and then maybe do a little bit more digging into that particular company to see if your investment thesis or if your conclusion from reading these numbers holds, if it has merit to it. And that's where the digging and the fundamental analysis comes in. And if it's true, then go ahead and short the stock. Okay, but I'm looking at the median because I want to extrapolate any outliers. And when you look at the median, the industry in this space, the market pays 1 times for those earnings growth. So when I'm looking at Amazon, I'm going to assume that the market is just going to pay 1 times for those earnings growth. So when you see here, 2021, earnings growth of 76%, we multiply that by 1.1 times, and of course we convert this into a whole number. We also multiply by 100. I get an implied PE multiple of 83. Now, 83 implied PE multiple expected that the market is going to pay for that is lower than their current PE multiple of 109. So you see that the growth of the stock, the growth of the earnings influences or impacts the PE multiple like I did here. But look at the price target. We get 3170 price target. That's a 39% upside. If we look at the following year, 2022, we get 42% EPS growth. Then the implied multiple, if we apply a 1-to-1 PEG ratio, we get an implied PE multiple of 46 times. Now, 46 times multiplied by the expected earnings of 54.14 gives us a stock price of $24.93. It is still higher from the current share price of $22.86, and that gives us a 9% return. And again, you can apply the same thing for 2023. And the question becomes, should you pay that premium? Do you believe in the analysis? Do you think Amazon will earn these expected earnings into the future? And do you expect them to grow at this rate? That's up for debate. That's why if you become an analyst, this is the type of analysis that you have to do. And you could go very detailed. You could be even more meticulous in validating those earnings by looking at their supply chain, by looking at the US economy, by looking at unemployment numbers, looking at discretionary spending or disposable income, and just see the correlation between unemployment and Amazon revenue growth, the correlation between Amazon revenue growth and perhaps increase in competition or increase in online traffic, because most of their business are focused digitally, with the exception of Whole Foods, because they acquire, now they are in the supermarket space. So there's so many different ways that you can validate these numbers by being creative and opening up a spreadsheet and calculating all of these things in detail, okay? So then lastly, if we apply a discount, right? Because you might have people say, okay, Luis, I see what you're projecting, but shouldn't you discount those earnings into the present time and then apply those multiples? Sure. Here, what if we use the cent-peg ratio, but we discount the earnings? So we're gonna keep the cent-peg ratio, but the earnings are not gonna be discounted. The discount rate that we use here was 9%. No. I think we have this in our spreadsheet. I could open up our spreadsheet and see what that discount rate actually is. So let's actually do that. Let's open up the spreadsheet. Let's see what's under the hood, and let's examine these numbers a little bit more carefully. Yeah, let's do that. And by the way, folks, after I open up the spreadsheet, I want to do a poll. I want to see what your take is on it. Will you buy the stock or will you not buy the stock after having this information and after we've done this level of analysis? I really want to get you involved. I want you to participate, and I want to see collectively what you as the participant, the audience, thinks about this analysis, and you can cast your vote, and then we're going to display it and show what everyone else is thinking. Here it is. Voila. Okay, so here's my WACC. So we assume a WACC of 7%. There's obviously a technical formula of calculating WACC. That's something that we cover in our program. If you're not familiar with WACC, it stands for weighted average cost of capital. Just what is the average cost of raising either equity or debt on a weighted basis when you look at the company capital structure. You can apply the capital asset pricing model to get your cost of equity, and then you can look at the bond pricing and also how much interest the lenders or the bondholders are charging Amazon to borrow money. And then you combine those two, you get the weight, and that's how you can come up with that 7%. So here it is. So we took the earnings and we discounted those earnings. Okay, you see that? 2021 earnings, 38 and 16, and we discounted it. And look at that, we get 38.48. Then we did 2022, we looked at 54.14 in expected earnings, the discounted number, 45.72. And then we applied the same multiples, right? You can see here the multiples are coming from our implied PEG ratio analysis. Then if we apply that multiple to the discount earnings, look at the share price that you get. So for 2021, next year, you do get 28.64. So you do have a 25% upside on the stock. So far, what I'm looking at into next year's earnings and a reasonable multiple of around 83 times warrants a higher price level from where we're at today, at least in my opinion, in my analysis. Now you do have other analysts that they might disagree. They may have information that I don't have. They may have a different perspective, or they might have a different opinion, and their DCF suggests a lower price target. Who's right or wrong? Well, the market will decide. But I think, based on the analysis that I'm doing, my numbers are reasonable. I think it's not outrageous or ridiculously outrageous to pay 83 times for a company that is earning $38 and is growing earnings at 76%, yet They are investing in their business. They're improving their processes. They're hiring more people so that when this is all over, they come out ahead. I do think that they deserve that multiple. But don't take my word for it. You could disagree. If you think, no, Luis, I wouldn't pay 83 times. I would probably pay the industry average. That's okay. But validate your investment thesis and put your money where your mouth is. Invest in the market, and then let's see who's right or wrong, right? The market is just difference of opinion. The challenge is, do you have the skill set? Do you have the tools to make this analysis and come up with the best decision that you can possibly come up with your analysis? And then you validate it with the market. You know, you could spend hours doing much more sophisticated analysis like this and still be wrong. This goes back to what I discussed in the stock analysis webinar, which we did a couple of weeks back. Is, look, you need to be nimble. You need to be aware of your own flaws or any potential blind spot that you could have in your analysis, and also be flexible to admitting that you're wrong and then take the other direction if you're wrong, if the market proves you to be wrong. This is just part of the job. So when I look at this and then I compare what the other analysts at these other major firms are reporting, I mean, if we take the median of all of these, let's see, what are they? 2712. Okay. Then my analysis, if I just take the median between the current PEG ratio or the discounted PEG ratio, just because I want to give some weight to both analysis. So the median between 31 and then the median between 28, I come up with 3,000. Okay. 3,000 for where they're currently at right now, 2286. What will be the potential return on that? So let's just calculate our change. -1. It's a 32% upside on the stock. If I had to really give a price target on the stock, I would not only look at this. Now I combine my technical analysis skills. I wouldn't just do this. This is where my trading experience comes into place. This is where my experience as a portfolio manager and also having other disciplines and skills can give me an edge. So fundamentally, we arrive either, we could do 2,800 or 3,000. Before it gets to 3,000, obviously, it has to get to 2,800. So let's just say on a fundamental basis, my price target is 2,800. Okay, so let's just put that right here. Price target, 2,800. Okay, but now let's look at the charts. Technical analysis. You know, and a lot of people may not like this form of analysis. It's okay. It's just another discipline, another tool in your toolkit to have when you're doing this type of analysis. So Amazon, and I see here the wave. Let me remove all of this. Move all drawings. Let's bring this down. So in terms of technical analysis, what I'm going to apply now is a Gartley pattern. And Gartley pattern basically says that stocks move in waves. They go up, they contract, and then they move up. But here's the key part. This first move from here to here, that wave is a measure move. You have your starting point, which is A. You have your peak point, which is V. Then you have a contraction period. This contraction period is your point B to C. And then your next move to the upside, that next wave equals to the previous wave, that A to B. And then this would be your C. So if you want to look at a very simplistic formula, A to B, for those of you that are math majors, A to B equals C to D in technical analysis. So let's go ahead and look at here. Look at what just happened. This will be your A point. This would be here your B point. This would be here your C point, and then your D point, right? If we actually expand this and look at the wave, so this is the range. I'm just going to take a very simple line to measure the wave. Let me duplicate this. Can I copy? Come on, custom create. Is there a duplicate? Why am I not getting? Okay, it's not giving it to me. So I'm just gonna take this move and place it at my C point. And this is my initial price target. That would have been my initial price target at the time we were looking at. Now, look at the most recent measure move. We had this major leg. So this would be my A point over here. This would be my B point. If this is the bottom, this would be my C point. Then my D point, where would it be? So I'm gonna take this measure move and I'm gonna add it to my C point, and then the next expected price level on a technical basis is up here. This would be my next measured move, 2,800. So from a technical analysis standpoint, my price target is 2,800. From a fundamental standpoint, my price is 2,800. That is my price target. So I just walked you through a very simplistic yet technical approach with the fundamentals and the technical analysis, chart analysis, in coming up with a 2,800 price point. They are both in harmony, okay? And that would be my price target for Amazon. So what would I do right now? The way I see this playing out, I would probably wait for this consolidation period right here. And then once we finish this consolidation period, if it breaks this resistance level, if it breaks this area right here, I'll start buying. And then my target would be $2,800. Some people would buy it down here at the support of this range. Okay, it's up to you, but you need to have stops in place. You need to make sure you understand risk management, because this is just one investment thesis. It could work, it may not work, and then we might see this. Maybe we might see a deterioration, the stock just continues lower. You need to have stops in place. You need to be flexible, okay? So, having provided you with this information, I'm going to open up the polls, and I want you to cast your vote. I want you to place your votes, okay? Let me know. What do you think? You should be able to see this in your screen. Will you buy Amazon stock or will you sell Amazon stock? And by the way, I'm just giving you my analysis, my homework. You have to do your own homework, but if you disagree, it's okay. Again, I could be wrong in my analysis, but I could also be correct. And it's combining the fundamentals with what the chart is saying, the momentum, to find harmony and increase your probability and your chances of being correct. That's what I just did here, okay? So let's see, we have almost 70% of you have casted your votes. What about the other 30? Are you guys sleeping? Wake up, smell the coffee. There we go, okay, 80%. Okay, so while most of you are still casting your votes, let me see. If there's any question, now is the time perhaps to type in your questions and I'll try to answer them. Let's see. And I do have questions. Valerie, could you explain how you got 2,800 from a fundamental analysis? Yes, Valerie, let's look at this again. Let me pull up my spreadsheet. How did I come up with this 2,800? This is more art than an exact science, right? The scientific approach is this analysis. It's applying different PE multiples using the industry, the current company multiple, and then seeing what the market would pay for the growth in earnings. This is the more scientific approach. But valuation is more art than science, and you also need to understand the story of the company, because companies that are growing do deserve a higher multiple than companies that are mature in a cyclical story life cycle of the business that is highly correlated to the economic expansion and contraction. So you need to understand the story of that. So my $2,800, simply, I'm looking at from a discount standpoint. Here we go, right? 28.64. And then I'm also looking at my PEG ratio without discounting the earnings, 3,100. I think, and then this 3,000 right here is just the median of both of those assumptions, but I'm going to give more weight to the discounted earning numbers, 28.64. So I'm just gonna round it. I'm gonna have a nice round number, and I'm gonna say $2,800 would be my price target. The rest of the street, right here, this medium, let me highlight this, right? The street has 27.12. I have 2,800 because I'm giving a lot more weight to my discounted earnings PEG multiple analysis. And again, I just want a whole round number. I'm bringing it down to 2,800. You might disagree. You might say, well, Luis, why not use 28.64? That's okay. There's nothing wrong with that. But I'm just walking you through my thought process, and I'm just gonna have a whole round number, 2,800. That's number one on the fundamental side. Then I looked at the charts. I did my Gartley pattern, A to B equals C to D price projection, and I also got 2,800 there. So there's harmony. It's just a way for me to do sanity check. So that's how I combine both of them. So I hope that answers your question on the fundamental side, Valerie, okay? Okay, you're welcome. And by the way, we're recording this. We're gonna upload it to our YouTube channel so that you can replay it and apply this analysis on any company that you may have. All right, both folks, so let's show our results. End the poll. Let's see, share. Wow. Look at that. I hope I'm not influencing your decision here to buy. I hope I am not influencing. I'm just giving you my homework, very quick and dirty analysis, which again, you could do on your own, but you could take it a step further by doing DCF, president transaction, some of the part, you could do so many more things, and then go deeper into the business and really build a full-blown model where you have a revenue buildup, a cost buildup, depreciation schedule, your debt schedule, even an employee schedule. I mean, you can get very fancy and sophisticated with these models. But 95% of you have a buy rating on Amazon. Wow. I mean, look, it's an amazing company. It's an amazing company. And what Jeff Bezos has created, it's nothing short of amazing. This is why this company, I mean, look at their market cap. If I pull up my numbers right here, look at the market cap. That 1.1, that's 1.1 trillion. They have $1 trillion valuation, $1 trillion enterprise value. I mean, think about that. But it makes sense. Why? I mean, look at the history of Amazon. Over the last 25 years, they go from zero revenue right here, 1994, zero revenue. Then the following year, 1995, $500,000 in revenue, then 15. I mean, guys, do you understand what it takes to go from $500,000 in revenue to 15 million in revenue from one year to the next? Listen, I am obviously growing and building Romero Mentoring as an educational platform. It's already challenging enough to come up with value that you guys, the student community, like and understand to accelerate this learning, because I didn't have this level of training. I didn't have someone to teach me these things. So this is one of the reasons why I'm doing it, to provide the level of training, the level of attention and dedication that I didn't have when I was in your shoes. And I'm growing a platform, I'm growing a brand, and I understand how challenging that is. But to understand this, $500,000 to 15 million in 1 year, it takes a lot. And look at this, going from, well, they don't disclose the number of employees in the first 2 years, but then from 151 to 614 employees. That's adding 463. If you're part of a student organization and you find it challenging working with 3 or 4 students, imagine you adding to your officers or to your entire team 500 people that you have to work with and be responsible for it. I mean, just think about that. See if your brain can process that. It's amazing what they've done. It's amazing. But there's obviously a process. There's obviously checks and balances in place that allows you to scale. And you get that with experience. All right? All right, folks. So let's see. Anyone else has any other questions? Let's see. Okay. Nope. No other questions? Okay. No. Yeah, you're welcome. It is being recorded. We're going to put this on our YouTube channel so that, again, you can go ahead and review it and improve your own technical skills. All right, folks. So, again, I just want to thank you for spending time this Saturday afternoon in going over this Amazon case analysis. I hope you find value in it. I hope you enjoyed it. And we're going to continue to do more of this to accelerate your learning and maybe help you a little bit more understand the technical part of analyzing a stock. So with that being said, folks, I'll end it here and I'll see you in the next one. Take care. Goodbye.